So, good morning, students. So, again, today we are continuing the same chapter, chapter number 6, capital and revenue expenditure and income. In our last class, we have completed capital expenditure and revenue expenditure. So, let's see once more what is capital expenditure and the revenue expenditure. Capital expenditure means those expenditures, the benefit of which is not taken only in 1 year, in the purchase year, but the benefit of that capital expenditure is taken for many years. So this is a capital expenditure for purchase of plant and machinery. The machinery purchase, but the machinery can be used for many years. Land and building, furniture purchase, all these are used for many years. So these are capital expenditure. And revenue expenditure means those expenditure, the benefit of this expenditure is taken or enjoyed within that current year only. The benefit, the revenue expenditure, so the benefit is taken within that current year only. It will not be carried forwarded. So payment of salary, payment of wages, payment of electricity bill, payment of rent. So these are the recurring in nature. Again and again you have to pay. So this is revenue expenditure. Now another topic, deferred revenue expenditure. In this deferred revenue expenditure, this deferred revenue expenditure, deferred revenue expenditure also refer to the revenue expenditure, but the benefit of which the benefit extend beyond the current accounting year. So this type of expenditure, but it is not a acquisition of any heavy assets. But this is also a revenue expenditure, but the benefit is also taken in the future year. So that means the benefit of which extend beyond the current accounting year. So however, such expenditure does not result in the acquisition of any permanent asset. Then, though we are this revenue expenditure, but we are taking the benefit not only in one accounting year, in the purchase year, but the benefit can be also taken in the next year also. But it is not a acquisition of purchase of any heavy assets. So this type of expenditure. So here, for example, heavy advertisement expenses is incurred to introduce a new product in the market. A company, at the time of launching a product in the market, they have spent a huge amount of money on advertisement. So advertisement is a revenue expenditure, but the benefit of advertisement is taken for many years. Because of the advertisement done in 1 year, advertisement is done in 1 year, the benefit of that advertisement will be taken by the business for many years, beyond one accounting year. The benefit can be enjoyed more than one accounting year, more than the expenditure incurred on advertisement, heavy expenses on the advertisement at the time of launching a new product. So when advertisement is done, the business organization incur a heavy expenditure. And because of the advertisement now, the goods will be popular in the market. Now, because of that popularity, a business can enjoy the profit, because more and more sale, more profit. So that means the benefit will be enjoyed beyond one accounting year. So this type of expenses known as deferred revenue expenditure. So here, for example, heavy advertising expenses is incurred to introduce a new product in the market. The benefit of such expenditure is enjoyed by the business over a number of years. So this is the example given in your book also. Advertisement expenses, heavy advertising expenses paid in one accounting year, but the expenses will give you the benefit for more than 1 year. Therefore, such expenditure is known as a deferred revenue expenditure. For example, example of this deferred revenue expenditure are heavy advertisement expenses, heavy repairs, expenses incurred in removing the business from one place to another place, research expenses. These type of expenses are known as deferred revenue expenses. So these are the examples of deferred revenue expenses. Now, capital expenditure we have done. We have done the revenue expenditure. We have done the deferred revenue expenditure also. Just meaning an example is enough for you. And capital expenditure and revenue expenditure, just you have to go to the differences between the capital expenditure and revenue expenditure. Now, let's go to the capital receipt and revenue receipt. Capital receipt and revenue receipt. Capital receipt refers to the receipt of non-recurring nature, such as additional capital from owners, loan raised by the firm, and money obtained from sale of fixed assets. So okay, these are a capital receipt. It refers to the non-recurring. It will not come again and again. Like owners will bring a capital in the firm, in the business. A loan taken by the firm from any bank, loan taken by the bank, by the firm business from outsiders. That is also capital receipt. So sometimes the old assets are sold, old machinery is sold, old furniture sold. The receipt from this type sale of fixed asset is also a capital receipt. So this is the example of the capital receipt by sale of old asset, capital introduced by the owner, the loan taken by the firm. All these are a capital receipt. On the other hand, we have the revenue receipt. Revenue receipt are those receipts which are obtained during the normal course of business and are recurring in nature. These revenue receipts are receipts obtained during the normal course of business and are recurring in nature. This receipt comes again and again, like by selling the goods. Every day business firm, business organization, they sell the goods. By selling the goods, you receive cash again and again, every day by selling the goods. So this is a revenue receipt. So interest received. Every month you are receiving the interest. You have given money to others in a loan for interest, or interest received from bank is also the interest received. Dividend received. So rent received. If you have a big building, you have given that building in the form of rent. So you receive rent for every month. This is a revenue receipt. Every month you are receiving. So this receipt neither create liability nor involves reduction in the value of fixed assets. So neither this you have to repay back afterwards. This receipt you don't have to repay back to the others. You don't have to repay back. So nor you are buying any assets also. Okay, so not you are involved in reduction of the value of the fixed asset, nor you are selling the asset also. Okay, so rather they increases the income of the business. This is the income of the business. So revenue receipts are credited to the trading account or profit and loss account. From the accounting point of view also, revenue receipts are shown in the trading account and profit and loss account, whereas capital receipts are shown in the balance sheet liability side. So this is the examples of the revenue receipt are amount received from sale of goods, total sales during the year are called turnover, interest and dividend received from the investment, fee and commission received for rendering any kind of services, rent received from tenant. These are also the revenue receipts. So capital receipt and revenue receipt. So you have to explain this capital receipt and revenue receipt in a short, and you should be able to also give the examples of these two revenue receipt and capital receipt. So this much only is in this chapter, a very short chapter, just meaning of capital expenditure, revenue expenditure, capital receipt, revenue receipt, and their differences also, and the deferred revenue expenditure. So this is in this chapter, capital receipt and revenue receipt.